Hey Oliver, what's up? Great stuff. You had me worried for a second there. Alright. Thank you very much. See you in a bit.
Hello and welcome here on the YouTube and Discord channel of Bookmap. My name is Oliver Sparring. It's the last Wednesday of the month again, so I welcome you to our webinar in English language this time. So what are we going to do? If you're here the first time, here's the plan for the session today. First of all, we're going to have a look at one of the trades that I personally did during the week. I did not trade yesterday, but I made a very nice little trade on Monday in the ES future. I usually screen record every one of my trades to later show them to my customers in the day trading educational program that we offer in German language. And as usual, one of these trades I am going to show you in our webinar today. We're going to have a look at how I use the software Bookmap to actually find good trading opportunities, how I enter my trades, how I manage them, how I use the liquidity map in Bookmap, the heat map, to actually manage my trades. And yeah, hopefully you'll get something out of this that you can use for your own trading style. After that, we're gonna have a look at the questions of you that reached us during the month. Please feel free, this is supposed to be an interactive webinar, so please feel free to use the chat function of Discord or of YouTube to ask me all your questions about trading, about the markets in general, about how to use the software Bookmap, everything you want to know something about. If you are not here with us live, but you're watching the recording of the session, you can also use the comment section to write your questions, or you can also write us an email to mail@sparring-academy.com. That is our email address. Ask us anything you want to know about. We're collecting all these questions and I'll see if I can answer them in one of our upcoming webinars. By the way, before I forget it, this is going to be the last session that we're doing on a Wednesday. Starting in July 2024, we're going to have our sessions on the last Friday of the month. So last Friday of the month, same time, 9 a.m. Eastern Standard Time. So I hope I'll see you guys next month on the Friday. So this is going to be our last Wednesday session, which is absolutely fine for me. Another thing that Bruce asked me about to show you is the special event which is planned for tomorrow, Thursday, the 27th. It's going to be a collaboration event between Bookmap and Axia Futures. Very nice guys, very interesting prop trading floor based in London. I think they've got some other floors in Australia and Poland as well. But as far as I know, their main base is in London. Really nice guys, really experienced traders. I also, by the way, did one of my educations over at Axia Futures many years ago. So I can absolutely recommend those sessions for you. The event is going to take place tomorrow and I am going to post the link to that in the... Oh, someone already did. I guess it was Dan. Yeah, you're already seeing the link to that in the chat function of YouTube, which is great. Thank you, Dan. So in case you want to take part in this event, please click on the link, register and sign up for it. And as far as I know, they're going to show you two of their strategies, how they combine their trading styles with the use of the software Bookmap. Very interesting. I really recommend you have a look at it. All right. Before we start, as always, I'm going to share my screen with you and we're going to have to quickly go through the disclaimer. which I opened twice now. So yeah, everything I'm gonna tell you about today is for educational purposes only. This is not meant to be any trading advice or financial advice at all. Trading the futures markets is connected to risk, and therefore every one of you trades in his own best interest and on his own risk. Not because Oliver Sparring told you so. All right, let me see if I opened the trade of the week already. I did. Perfect. Okay. So if you're new to my webinars, let me just quickly tell you what you're seeing right now. As you might have already realized, this is no live chart. So in case you're wondering why the market looks a bit different than what you're seeing right now on Bookmap, this is a screen recording of one of my trades. In particular, a trade that I did last Monday in the ES future. And I always record these trades and put them in DaVinci Resolve and speed them up a little bit so we don't have to look at 20, 30, 40-minute trading situations here, but we can see everything quickly and at a glance. Okay, so let's first talk about the basic situation that we are seeing here. On the left side, you are seeing a 5-minute chart, very conventional, nothing special. You're seeing two volume profiles. On the left side, this is the profile of the pre-session. On the right side, this is the profile of the cash session, the regular trading hours after the market opened at 5:30 European Standard Time, which is 9:30 EST. On the right side, of course, you're seeing the software Bookmap, and what you might notice on the first side is the colorful lines in it's the lines that you are seeing synchronized between the Bookmap chart and the 5-minute chart. Those lines are my market analysis, my levels that I am setting up every morning together with my customers in the day trading education. We are having a look at the markets from different perspectives. We are including different factors like dealer hedging, gamma levels, Vanna levels, charm levels. We are including, of course, liquidity in combination with volume and market profile levels, Fibonacci retracements, anchored VWAPs in general, of course, dark pool levels. So we are trying to have a look at the market from really many different perspectives, and this is the main factor. We're combining all those factors for a very powerful and meaningful kind of market analysis that gives us high quality levels where we're actually looking for our trading opportunities. Really important in day trading, and especially discretionary day trading, the kind of trading style that I am executing, is that you always want to answer two questions: the where and the what. Where is it supposed to happen, and what should happen on these levels? This is like the foundation of everything that we're doing. We never want to find a trading opportunity in the middle of nowhere, just where there's no institutional interest in the markets. We always want to define first where we want to find trading opportunities, where we're even looking for trading opportunities, and that is what our market analysis is perfect for. So at first we're setting up those institutional trading levels, and as soon as the market reaches one of those levels, we're gonna have a look at the context. Context is king, you know. We never want to wait for a market to arrive at one of those levels and then think about, should I go long or should I go short on this level? What is even supposed to happen here? We always want to have this plan in advance. So as I said, we're combining different factors, different perspectives on the market, and as soon as the market reaches those levels, we want to have a plan in advance what we're what we'd like to see to happen on these levels. And this is where Bookmap comes into place, and this is where we want to answer the second question, which is the what. What is supposed to happen there? We never ever want to just place a limit order on one of these levels and hope for the best. This is not how trading works, at least not from my point of view. As I said, those levels are perfect locations for finding institutional interest in the market, but as soon as the market reaches those levels, we never want to just open up a trade, but we want to have a look at the heat map, at the order flow, at Bookmap, and we want to evaluate if a trade is justified on these levels or not. And as you can see, we already got this dark pool and weekly VWAP level here at the 55.43-ish, 55.44 prices. And obviously, this was a level of high interest too. You can see the market, as soon as it opened up on Monday for the regular trading hours, we had this momentum run to the upside. We really crushed the pre-market high, no problem for the market to push through. But then we had this quite rather fast pullback too, and the market was approaching this dark pool and VWAP level, and this originally was the level where I wanted to enter the market on the long side, because actually the context was showing me we're in a long trend. Of course, we got a little pushback, we got a little pullback the last days. However, as long as the market was holding itself above this green VWAP line that you can see here in the 5-minute chart, the general direction that I wanted to find trades in was the long side. So this was the first, this was like the first level where I was looking for long opportunities to actually enter the market on the long side. But as you can perfectly see here in Bookmap, there just was not the right setup to do so. We're gonna have a look at this question a little bit later. What are the 5 factors that I include in my own trading style, that I'm having a look at and that I include in my own trading decisions? But one of them is obviously the active market participants, those market participants that open up their trades by using market orders. And those are obviously the ones that enter the market aggressively and that are showing initiative. So we always want to have initiative on our side if we want to enter a trade. However, in this particular case, we can't see any initiative. You're probably not used to my colors. You're probably having red and green volume dots in your own trading software, in your own Bookmap version. But yeah, I'm just used to those white and teal colored candlesticks and also white and teal colored volume dots in Bookmap. So teal is always, obviously it's bearish candles in my chart, and teal are also the market sellers. So the negative delta in my volume dot chart. And on the other hand, the white dots, those are the active market buyers. And obviously, when I want to open up a trade, I want to have aggressiveness on my side, I want to have active buyers on my side. And as you can perfectly see here in this situation, there simply are no active buyers. We can see there's a lot of selling pressure coming down as the market approaches these levels. There's a lot of liquidity that has been filled here in the area of 55.44 up to 55.48. All those limits getting filled, which is nice in advance of approaching a level. However, as soon as the market reached it, it's just went sideways, consolidated in this area, and as you can see, there is just no initiative. There is just no market buying to be seen here on the level. So there's no reason for me to open up and jump into a long trade as soon as I do not see any buying. However, what I can see is that there's new liquidity coming in here on the ask and also here in the bid. So when this happens, I usually just wait how the market reacts to new liquidity approaching the market. Two important concepts in case of liquidity. In general, we wanna compare liquidity that lies in the market for a long-term period and that is to be found further away from the market, from the current price. And on the other hand, liquidity that enters the market, that is stacked into the market near the price, and that comes in quite spontaneously. So the first type, the orders like this one here at the 55.55, or also the one up here at 55.59. Those are usually big orders that lie in the market for a longer period of time, that has a certain size which stands out. If you are taking a look at the ask at the DOM levels here on the right side, you can see this really is a huge order here at the 55.55 compared to what lies next to it. And if this is also an order that is not moved for a longer period of time, but that just lies there in the market, we can assume that this is a real order, and that is a order that was placed by an institutional market participant and that has the purpose to be filled sooner or later. And therefore, this is an order that acts as a magnet to the market. We can always assume that the market sooner or later comes up to these price areas to fill these kinds of orders. In this case, we can also assume that since the order lies at a negative gamma level coming from the SPY, that this is probably liquidity that is placed by a market maker to actually hedge their book. And of course, for other institutional participants like hedge funds or in general funds that are supposed to speculate directionally, of course, this liquidity is very valuable since they can use it to open up their own trading positions by aggressively buying. So this is the first category of liquidity that we're going to have a look at. Where is the imbalance in the book? Where do we find more of those big orders that are placed further away from the current price? The second second kind of liquidity orders or limit orders are those that are being placed quite spontaneously and near the current price. So this kind of liquidity here in the area of 55.47 up to 55.50. This is, at least for the moment, this is the more interesting kind of liquidity because this is usually spoofing activity, and this is what makes the market move on a more shorter kind of time frame. So it's always a bit complicated, and this is the part that takes a bit of experience to actually be able to interpret those kind of liquidity positionings. If the liquidity is placed really near the current price, so really in an area of 1 to, let's say, 10 ticks around the current price, we can usually expect the price to reflect from those kind of spoofing orders. So in case we've got, let me just pull out the pen. So in case we are seeing a lot of liquidity coming here on the downside right beneath the price, and the price reacting like this, so it really reflects from these kind of orders. That would be a very bullish sign in this case. However, since the liquidity is not placed right around the current price, but a bit further on the upside here in the ask. It's always a bit difficult to interpret those kind of orders. So what we're usually doing is we're just waiting, and we're gonna have a look at how the market actually reacts to those kind of stacking activities. If the liquidity is placed like right here, and we immediately see a push to the downside, we can assume that this is a spoofing activity, which is there to actually scam the market and show the market false strength on the upside. We can see this as a bearish kind of activity and bearish kind of sign. However, if the market reacts to the opposite and runs into this cloud of liquidity right away, and those orders don't disappear, but instead they are being filled, then we can see and regard this as a more bullish kind of sign. So what I want to say is the orders that are placed in a range of, let's say, let's not be too exact here, in a place around like 5 to 10 points around the market. What I usually do is I'm just waiting a few seconds, and I'm just gonna observe the market very carefully, and I'm just gonna have a look at how the market reacts to those orders. So in this case, market runs sideways, doesn't do anything, but then comes down to fill the new liquidity which was added and stacked here in the bid. So as soon as the market reaches and approaches my next level, which is the yesterday VWAP level, we can see that the market selling suddenly and immediately turns into market buying. We can see all these teal colored volume bubbles, volume dots here on the left side, and as soon as all those orders are filled, the market turns white right away. Also, we can see that at this point, there is no new liquidity added further on the downside. But instead, as soon as the market buying comes in, we can see those kind of spoofing orders that I just talked about, that are really being placed near the market and just a few ticks beneath the current price. And this is what immediately pushes the market to the upside, and this is actually a very strong bullish sign. And the most important thing, the most important factor in this place is the location where this happened. As I said, the first question that I always want to answer is, where do I want to trade? This is what my levels are for, this is what my market analysis for, and as you can see, this situation, this trading opportunity appeared right after approaching one of my levels. This is, like, for me, the most important factor. And this is why I opened up my long position with, I think, 2 contracts. Yeah, right. I opened up the first contract here on the 55.39 and expected the market to push a bit lower again to maybe test one of these orders that have been placed in the bid here. However, the market went straight up after placing the first contract into the market. That's why when the market made this small pullback here, I opened up the second contract on the same price, because I didn't want to risk not getting filled with my second contract here. I didn't expect the market to come down to these prices in this case. However, what the market did, it actually came down to test these orders, and it even filled this one. So as you can see, I've got my stop order placed 3 ticks beneath this bid order. And to be honest, this was not more than luck. So there was a great chance that the market actually pushes 1 tick lower and fills my stop order. So in this case, I just got lucky. The important thing is to always put your stop order in a position where it actually makes sense. So you always have to assume that the market is not interested in where you as a private retail trader place your stop. So you want to always place your stop on a place or on a spot that actually makes sense from a fundamental point of view. So you can either use the last low, which always makes sense, and that is what Bookmap is a great software tool for. You can also always use those kind of spoofing liquidity orders that are actually acting as a kind of shield, as a kind of protection for your stop order. You do not want to place your order right into this limit order in the bid. And also, as you can see, not like one tick below this, but you always want to have a kind of puffer of like 2 to 3 ticks. For me personally, I will always place it like 3 ticks beneath those levels, because as you can see, usually the market, when it pushes inside those kind of orders, it usually pushes through 1 or 2 ticks further before it then continues to move in your desired direction. Yeah, in this case, as I said, there was a high chance that it always or that it also pushes further 1 tick. However, I got lucky and I didn't get stopped out in this case. By the way, stop is, let me calculate, it's at, entry is at 55.39, stop order is at 55.36.75 around, so we've got a stop of 9 ticks. And on the other hand, our target for this trade is up here at 55.50, so around 44 ticks, which is a very nice risk reward in case this trade plays out as supposed. Okay, first thing that comes to my mind when I see this. As I said, this is a recording, and this is I've sped it up a little bit. So we entered the trade here at 18:51. This is my local time. This is Dubai time. So this should be around 10:51 in the morning for Eastern Standard Time, if I'm right. We should have 8 hours difference at the moment. 8 hours or 9 hours? I'm not sure. You've got 6 hours to Middle European time and 2 hours. Yeah, 8 hours should be correct. Yeah, so right. Yeah, 10:51 should be the right time in the morning. So 10:51 is where we enter the trade, and at 10:54 we can see that we actually did not get any follow through with this trade. The market is just tending to move sideways. Instead of seeing more active buying, we can see how the sellers came in back. So this is of course not a thing that you want to see when you trade a kind of reversal situation. What you want to see when you trade a reversal is that the party that you're actually trading with, in this case the buyers, stay strong. Of course, those kind of pullbacks are very common. You have to count with those pullbacks. However, after a pullback, you want to see strong buying coming in right away, pushing the market further upwards. The longer it takes to actually see this kind of follow through that I was just talking about, the less or the more decreased are your chances that your trade actually plays out, and the more aggressive you should actually place and move your stop. So if I trade a reversal and I do not see what I want to see or what I was expecting to see right away, I usually take my stop and I'm gonna place it further to my break-even, closer to my break-even point in this case, because I see that my chances for receiving a winning trade have just diminished. That's why I always want to reduce my risk on the same side too. So in this case, I got lucky. As I said, I didn't get stopped out in this place. And then right after, I'm seeing the first market buying coming back into the market. I'm seeing new liquidity being stacked and placed here in the bid, which is also pushing the market to the upside right away. And this is what I would have loved to see right after I entered my trade. But in this case, it just took the market like 3 to 4 minutes to actually see new buying coming in. And that is why I placed my stop very aggressively here in this case. So what we're also seeing is this teal colored line. This is actually MBO data. This is an open iceberg order that just came into the market, and we usually can assume as soon as one of those iceberg orders comes into the market that these orders are actually getting filled by the market sooner or later. So this is good for us, and there we can see the iceberg getting filled, and we're approaching the next level, which is this dark pool and weekly VWAP level. And this is where I expect the market to actually stop for a while to get some resistance. This was the perfect moment for me to actually move my stop very close to the break-even point. In this case, it wouldn't have made sense to actually put the stop right onto the break-even point, because this is where this big limit order right on my break-even order is lying. So I just, again, similar to what I did here, I'm placing the stop like 3 ticks beneath this limit order, so it's protected well. And yeah, well, if I get stopped out with 2 or 3 ticks loss, this is absolutely fine. This is something I can live with. So let's see how the trade played out afterwards. We're getting this breakout and this push through the dark pool level, which is great. This is exactly what I wanted to see. And after I'm getting or I'm seeing this stop run here on the upside, I'm taking out my first of the 2 limits of the 2 contracts. I already reached a risk reward of, let me just calculate very quickly. It should be around 2.5-ish around. So already a great trade with the first contract. And what I also did after getting this fill, I moved my stop order to the break-even point, since now my second contract is very well protected by the dark pool and weekly VWAP level. So perfect. Finally seeing the follow through that I wanted to see. And as you can see, my second limit order is right here at the yesterday high level, which is also a negative gamma level. We've got a lot of liquidity here. And with this push, it finally got filled and the trade was over. Oh, sorry. Yeah, some final words. We made a profit of $900 with this trade. The first stop, I think we risked around 200, so we've got a nice risk reward of around 3.5. Everything played out, yeah, quite perfectly, I must say. In this case, I was a bit lucky that I didn't get stopped out in this situation here. However, afterwards, we saw a lot of buying, and actually, this was a great point to leave the market, because, of course, I was still long. My general approach, my general direction was still long at this point. But if you remember Monday, after reaching the yesterday high level, the market made a lot of sidewards movement here between the dark pool level and the gamma level. So this was like a very good point to actually leave the trade and close it. All right, this was the trade of the week. Let me just take a bit of water and have a quick look if there are any questions. If you just entered the webinar, please feel free to use the YouTube chat function to ask me your questions, or if you're actually watching us on Discord right now, you can also use the chat function of the Discord server. All right. No, this was the wrong button. Sorry. There we go. Okay. Let's just have a quick look at the questions that reached us during the last week. And the first one of this being, what is MBO data? This was a question someone asked in the comment section. So let me just answer this as quickly as possible. We're going back to the Bookmap screen. So what is MBO data? MBO stands for market by order, and this is a kind of data set that you can subscribe to, and that right now at the moment only very few data feeds are actually offering. I think there is Rhythmic as the best and most well-known data feed that offers MBO data. There is DX feed. I'm not sure if they are already offering the MBO data set, but I'm pretty sure that they're planning to do so. And the third one that I know of is the Denali free feed from Sierra Chart. So I'm pretty sure that most of you know the expression MBO data from the Rhythmic feed, and actually it's not been so much of a long time since we actually can receive this in market by order data. I think it's like 4 to 5 years. So this is quite new technology that we as retail traders have access to, and it's a great kind of data set that we can use to further validate our trading decisions, our trading opportunities. So what you surely know is the usual and common level 2 data. This is what you probably all are subscribed to when you're using Bookmap. Level 2 data simply means that you have access to see all the limit orders that are currently placed in the order book. You can see all the limit orders that are placed above the current price in the ask, in the offer, and you can see all the limit orders that are placed in the bid below the current price. So this is the usual and normal market level 2 data. So what MBO data is capable of doing is it actually connects each order that is placed at an exchange to a certain order ID. So each time you place a market or a limit order into the market and you tell your broker to buy there, to sell there, to sell there, each and every one of those orders has a certain ID connected to it. So now, as you certainly know, if you're a big institutional trader, let's say you're a hedge fund manager and you're supposed to open 10,000 contracts in the CL crude oil future, you are not simply able to just put those 10,000 contracts in your trading software and click on buy. I mean, you could do that, but you'll probably be jobless the next day because you're actually moving the market massively into your desired direction, and therefore you're destroying your own prices, which you don't want to do. You also should not, or you also cannot just place those 10,000 contracts as a limit order somewhere beneath the price, because actually everyone would see this order, and the front-running algorithms by other institutional market participants would simply make sure that this order is never reached. So what you're forced to do is you have to open up those 10,000 contracts. You have to buy those 10,000 contracts step by step. And therefore, you're forced to use what we call iceberg orders. So you only place a certain kind of fraction from your order into the book, let's say 100 contracts. And as soon as these 100 contracts get filled, you're placing the next 100 contracts until eventually and ultimately your 10,000 contracts are filled sooner or later. So of course, those institutional market participants, they don't do this manually anymore. They've got their algorithms, they've got their software, which actually does this for them. One of the softwares is, for example, Synthetics SE by Trading Technologies. Very advanced software to do this. But what most institutional participants are still doing is they use the chance to actually commit their orders directly to the exchange, and they're actually telling the exchange to place their order step by step by what we call an open iceberg or a dynamic iceberg development order system. So what MBO data is capable of doing now, as soon as a market reaches an order of, let's say, 100 contracts, and these 100 contracts get filled, and then later comes back to the same price, fills another 100 contracts, and it realizes that those 100 contracts actually have the same ID as the 100 contracts before, they can connect these two orders to each other, and they can actually tell us, okay, this is where a native iceberg order has been placed by an institutional player to the exchange. And this is how we are actually able to follow these iceberg orders and to actually make them visible in the markets. Right now, I do not have an open example in the ES future, but I think let me just get back to the trade that I've shown you earlier, because you can see it very well here. You can use different kinds of software to actually make these kinds of iceberg orders visible. You can use the iceberg and stop tools by Bookmap directly, which are great tools. I use the Trade Finder plugin connection to make them visible. But as I said, this is totally up to you. There's a lot of great software out there, and I can totally recommend the tools from Bookmap. You can download and subscribe to them via the marketplace. They are absolutely great, and they doing the exact same thing as the Trade Finder does for me. So what you can see is this teal colored line here. This is showing me a native selling order, so a native iceberg order that has been placed to the ask by some kind of institutional player. And you can see this little sign here on the right side. It shows me that at this point in time, 10 contracts of this open iceberg orders have already been filled. It shows me where the iceberg order, at which point in time the iceberg order has actually been placed into the market. And here, I'm not sure if you can read this on your monitors, on your screens. This actually shows me the time period that the iceberg order is already open for. Of course, what it can't show me is the total size of how many contracts are yet to be filled. This is very important. We can only see how many contracts have already been filled by the algorithms, but we never know how big the iceberg order will be in total. However, this is of course very, very interesting information for us, because if I now see that there is an open DID, an open dynamic iceberg development, and the market decreases in price, the price is falling, and we can still see that the iceberg order remains open and is not being pulled downwards, we can always assume that sooner or later the market actually comes back to this open iceberg order development and fills it. So this is like the first big advantage that we get from MBO data, market by order data. The second big advantage that we actually get is that market by order data is able to differentiate or to actually show us the order type. Sorry, my phone is ringing. the order type that an order got filled with. So as you surely know, we basically got two big kinds of order types. The first one is a limit order. The second one is a market order. Limit order are the ones that we actually place into the book. We add liquidity to the market and we're waiting for the price to arrive there to actually get our fill. While with a market order, we tell our broker to buy or to sell at the next best available price in the book. So the problem now is if we are placing a stop order, the stop order always turns into a market order if it gets filled. However, before the times of MBO data, we actually never knew if an order that got filled market was actually once a stop order or which was a simple market order. So what MBO data can now do, it can differentiate between those two types. It can actually tell us if a market order was originally a stop order or if it was a conventional market order. This is very useful because, as you can probably see here in this case, as soon as actual stop orders get filled, this can be, of course, always in the right context, but this can be a point in the chart where the market actually turns and reverses to the other side. So if we are watching and if we are capable of seeing big stop orders getting filled on let's say certain price locations, we can use these kind of signals to enter the market very aggressively and to realize really great risk reward trades. So yeah, this is also what market by order data can do. It can show us where actual stop orders have been filled. Great thing to do. Yeah, and I really recommend you all check out this market by order data set from the Bookmap marketplace. They've got great stop order indicators, they've got great iceberg indicators, and yeah, just experiment, use this data to make statistics, and hopefully and eventually you'll be able to use this market by order data to your advantage. All right, market already opened. I was just talking a bit much today, but I still want to answer the second question. Oh, there's a lot of questions. Do you scalp or are you looking to hold positions for longer? Well, I kind of would call myself a typical day trader, I would say. I'm definitely not a scalper. So my trades usually run between 10 minutes to, let's say, 2 hours at the longest. I'm not the one who actually builds up a position over time and adds contracts to winning trades. That is not my kind of trading style, although it's very effective, obviously. I do have a trading idea and I'm looking to reach risk rewards between, I would say, 2 to 4. And it's a question of your trading personality, of your own kind of trading style. I would never say that you can simply take a trading system, a certain kind of trading system with exact entries and exact exits, and just apply it to each private retail trader out there and just tell them, here's the system, have fun, good luck. You always have to take into account your own character, your own trading personality, and you have to find a way of trading and an approach to trading that actually suits to that kind of personality, that actually fits your kind of trading personality. So there are actually traders, and it's very interesting for me too, as someone who actually teaches trading, to see my own trading students developing their own kinds of approaches and their own kind of trading personalities and styles. And there are those who actually enter the market, as I said, enter the market very aggressively, try to get the best prices on the trading locations that I talked about earlier. And that they also leave the market quite quickly, and they are following a more kind of scalping style. While I usually, when a market approaches my level, let's say we're taking this volume market profile level down here, I see all this liquidity getting filled. Of course, after I see this exhaustion run here, I could just try and enter long very aggressively down here. However, this will probably not lead to a very great hit rate. So you'll probably get stopped out quite a lot when you follow these approaches. On the other side, this can give you great risk-reward ratios. If you're the first one to enter the markets. I am the one that waits for more confirmation. I always, as I said earlier, always want to see initiative. When I want to fade a market on a certain level, I want to see, let's say in this example, I want to be a buyer. I want to see aggressive buying like it happened here. And I also want to see a kind of initiating breakout out of a microstructure range that is happening here on the trading location. So I'm more the kind of classic day trader, I would say, but I'm also not the one who holds the trades for 5, 6, 7 hours or even throughout the whole day and builds up possessions. This is not my kind of trading style. As I said, I'm in a trade for somewhere between 10 minutes to 2 hours, and I always want to try to reach like the next level or the level after that to exit my trades. Looks like the Q&A. Yeah. Is that a tree in your room, or is your room in a garden? No, this is an artificial plant wall in our room. All right. One last question is here. In your last webinar's Trade of the Week, you spoke about different factors that you take into account for your trading. Can you please speak more about what those factors are in particular? So very quickly, without getting too deep into the nitty-gritty, I want to always have a look at 5 different factors. It's not that, I mean, trading obviously is never by textbook. It's always, each and every situation is different, and the market never shows you situations that are just applying to exactly what you learned in your trading education, in your trading course, or from your teacher. So you always have to, as a discretionary day trader, as someone who reads the order book, you always have to stay flexible. However, you always want to answer 5 different questions, or you always want to just have a quick thought on each of these 5 different factors. Number 1, what are the passive market participants doing? Sorry, difficult word for a German. What are the passive market participants doing? So how are orders placed in the book? How are they moved? Where does pulling take place? Where does stacking take place? So generally, how is liquidity moving? What are the active market participants doing? This is obviously very important. As I said, you always want to have initiative on your side. What's the speed of the market? The velocity of the market, and also the velocity of the auction, and how does it change as soon as one of your trading locations is reached? Point number 4 is, can you see order flow events? Let's call them this. Can you see certain order flow events that are confirming your bias. Like, for example, can you see stop runs? We just talked about this related to MBO data. Can you see stop runs? Can you see exhaustion runs? Can you see iceberg orders filled? How is the volume developing? All those kind of events. Can you see, if you're using the footprint chart, can you see stacked imbalances that have been built up? Those factors. And the last one, and obviously a very important one too, how is the price action developing? What is the price actually doing? How is the market structure forming? How is the market profile forming? Can you see any single prints? Can you see buying tails, selling tails? And also very important, how is the market structure in the microstructure here forming? You can use Bookmap very well for this, since this is not a time-based chart, but a chart that is constantly moving, and it's moving faster as you zoom in further, and it's moving slower as you zoom out further. This is a very particular and very, very useful kind of view at the market. Of course, always in the context of the bigger picture of longer time frames. Yeah, but how is price action developing? So those are the 5 main factors that I personally take into account before every single trade. I always want to say something to each one of these 5 factors. This is the basic fundament that my trading style is based on. Okay, so let's just have a really quick look at what the market is doing. We won't be able to do our usual market analysis today because there was a lot of questions coming in, and I think I talked a lot about my trade of the week this time, so sorry for that. However, what we can see is, and what we can observe here, the market opened at 17:30. This is 9:30 Eastern Standard Time, so we can see market came down here to this volume profile level earlier. This liquidity got filled. There was a lot of new liquidity coming in here in the bid. At this point in time, I would have assumed that the market would tend to move lower to actually fill this cloud of liquidity. We can zoom out a bit. But, however, right now, a lot of this liquidity is either pulled from the book or even moved higher up, which is quite a bullish sign at this time. Quick look at the 5-minute chart. We're currently above yesterday's high. Are we? No, not yet. Sorry for that. Yesterday's high is actually up here, but we're still in a clear uptrend. This is the SPY chart. This is the SPY 1-hour chart, and we can see we're still above this particular anchored VWAP. So the average buying position is still in the green numbers according to this. So what I would do is I would wait a bit how this plays out. As long as the market is above the yesterday low level, which is down here, which is a very, very strong support. It's a positive gamma level. It's the yesterday's lows. It's a very certain kind of Fibonacci level. This is a very strong support. So if the market comes down there, this is where I want to look for entries on the long side. As I said earlier, very important, this does not mean that I just simply put my limit orders down here and wait for the market to come down and then get filled and hope for the best. It's always the two sides of the coin. We want to wait for the market to approach this kind of level. We want to have a bias, but then as soon as the market is there, we want to find confirmation in the order flow. We want to take a look at Bookmap, and it actually looks like we are getting some news. I haven't even taken a look at the economic calendar today, but as you can see, the liquidity is being moved out of the market, so we'll probably having news at 4 p.m. So yeah, you just want to wait until those news are over, until liquidity is being added back into the book. And then as soon as volatility decreases and the market stabilizes again, this is where you want to find new trading opportunities. All right, so this is a good opportunity to buy down here if the order flow gives you the right signs, and also to be a buyer. Personally, I want to see a breakout above the yesterday high level. This would be perfect. All right, guys, we have to finish this session at this time. I'm going to have a customer call right away. So I hope you liked it. Please feel free to ask your questions in the comment section if you're watching the recording of this video. You can also find us at mail@sparring-academy.com. As I said, beginning next month, we're having our sessions on the last Friday. So hopefully see you there. Have a great day and good trades. Bye-bye.